Question 1. A bond with a 5% coupon and $1,000 par is purchased for $800. What is its current yield? Is it A, 8%, B, 4%, C, 6.25%, D, 5%? The correct answer is C. Current yield equals annual coupon income divided by market price, or $50 divided by $800, which equals 6.25%. Because the bond trades at a discount, the current yield exceeds the 5% coupon rate. Current yield ignores any gain realized at maturity. Question 2. Which order type guarantees execution but not price? Is it A buy limit order, B, a stop limit order, C, a limit order, D, a market order? The correct answer is D. A market order is executed promptly at the best available price, guaranteeing execution but not a specific price. A limit order guarantees the price or better but may not execute. Stop limit orders combine a trigger with a limit and likewise are not guaranteed to fill. Question 3. A mutual fund has $500 million in net assets and annual operating expenses of $6 million. Its expense ratio is closest to, is it A, 8.3%, B, 2.4%, C, 1.2%, D, 0.6%? The correct answer is C. The expense ratio equals annual operating expenses divided by net assets. $6 million divided by $500 million equals 0.012, or 1.2%. It represents the yearly cost of owning the fund as a percentage of assets. Reversing the fraction produces the 8.3% trap. Question 4. A company's stock trades at $60 and reported earnings of $3 per share. Its price-to-earnings (PE) ratio is it A, 5, B, 180, C, 20, D, 0.05? The correct answer is C. The price-to-earnings ratio equals share price divided by earnings per share. $60 divided by $3 equals 20. The 0.05 trap inverts the ratio, earnings divided by price, and 180 comes from multiplying instead of dividing. A PE of 20 means investors pay $20 for each $1 of annual earnings. Question 5. A closed-end fund is trading at a price below its net asset value. This is described as the fund trading at, is it A, discount, B, par value, C, its redemption value, D, a premium? The correct answer is A. Closed-end fund shares trade on an exchange at a market price that can differ from net asset value. A price below NAV is a discount, and a price above NAV is a premium. Open-end, mutual, fund shares always transact at NAV, so the trap is assuming a fund must trade at NAV. Question 6. An investor earns a 12% nominal return in a year when inflation is 4%. Using the approximate method, the real return is closest to which of the following? Is it A, 48%, B, 16%, C, 3%, D, 8%? The correct answer is D. The approximate real return is the nominal return minus the inflation rate, or 12% minus 4%, which equals about 8%. Real return adjusts nominal gains for the loss of purchasing power. This distinction matters when evaluating whether an investment truly grows wealth. Question 7. An investor who buys a put option is generally expressing which market view? Is it A, bearish on the underlying asset, B, expecting no change in volatility, C, bullish on the underlying asset, D, neutral, seeking only income? The correct answer is A. Buying a put gives the right to sell at the strike price, which becomes valuable if the underlying asset's price falls, reflecting a bearish outlook. Puts can also hedge a long position. A call buyer, by contrast, is typically bullish. Question 8. Using the rule of 72, approximately how long will it take an investment earning 8% compounded annually to double in value? Is it A, about 9 years? B, about 12 years? C, about 6 years? D, about 8 years? The correct answer is A. The rule of 72 estimates doubling time by dividing 72 by the annual rate. 72 divided by 8 equals 9 years. The trap answers come from subtracting the rate, 8 years, or misdividing, 72 divided by 12, or 72 divided by 6. It is a quick approximation for compound growth. Question 9. A yield curve that slopes downward, with short-term rates higher than long-term rates, is described as which of the following? Is it A, an inverted yield curve? B, a humped yield curve? C, a flat yield curve? D, a normal yield curve? The correct answer is A. An inverted yield curve occurs when short-term interest rates exceed long-term rates and is often watched as a potential recession signal. A normal curve slopes upward. A flat curve shows little difference between short and long maturities. Question 10. Which measure best captures the total percentage gain from an investment, including both price change and reinvested income? Is it A, current yield? B, total return? C, nominal yield? D, coupon rate? The correct answer is B. Total return combines price appreciation and income, such as dividends or interest, giving the complete measure of performance. Current yield reflects only annual income relative to price. Coupon rate and nominal yield reflect only a bond's stated interest, not price changes. Question 11. Which bond carries the greatest interest rate risk, all else equal? Is it A, 5-year bond with a high coupon? B, a 30-year zero-coupon bond? C, a 2-year bond with a high coupon? D, a 5-year zero-coupon bond? The correct answer is B. Interest rate risk increases with longer maturity and lower coupons, both of which lengthen duration. A 30-year zero-coupon bond has the longest duration and thus the greatest price sensitivity to rate changes. Shorter maturities and higher coupons reduce that sensitivity. Question 12. Which of the following is a leading economic indicator? Is it A, the average duration of unemployment? B, corporate profits reported for the prior quarter? C, the unemployment rate? D, new building permits issued for housing? The correct answer is D. Leading indicators, such as new building permits and stock prices, tend to change before the broader economy does. The unemployment rate and average duration of unemployment are lagging indicators. Prior quarter corporate profits reflect activity that has already occurred. Question 13. Which account type generally allows contributions of after-tax dollars with qualified withdrawals being tax-free in retirement? Is it A, SEP IRA? B, Roth IRA? C, 401k with pre-tax contributions? D, traditional IRA? The correct answer is B. A Roth IRA is funded with after-tax dollars, and qualified withdrawals in retirement, including earnings, are tax-free. Traditional IRAs, standard 401k, and SEP IRAs typically use pre-tax contributions that are taxed upon withdrawal. The Roth's tax-free growth is its defining feature. Question 14. A real estate investment trust, REIT, must generally distribute what portion of its taxable income to shareholders to maintain favorable tax treatment? Is it A, no more than 25%? B, at least 50%? C, exactly 100% in all cases? D, at least 90%? The correct answer is D. To qualify for pass-through tax treatment, a REIT must distribute at least 90% of its taxable income to shareholders as dividends. This high payout is why REITs are valued for income. REITs let investors gain real estate exposure without directly owning property. Question 15. Under the Uniform Securities Act, the state official who administers securities law is known as the Is it A. Administrator, B. Registrar of Deeds, C. Trustee, D. Comptroller? The correct answer is A. The Uniform Securities Act refers to the state securities regulator as the administrator, who enforces the act, registers securities and professionals, and pursues violations. The administrator has broad authority to make rules, conduct investigations, and issue orders. This term is used consistently throughout state blue sky law. Question 16. An efficient frontier graph plots portfolios according to which two dimensions? Is it A. Dividend yield and price-to-earnings ratio, B. Expected return and risk, standard deviation, C. Liquidity and tax efficiency, D. Alpha and beta? The correct answer is B. The efficient frontier plots portfolios by expected return on one axis and risk, measured by standard deviation, on the other. Portfolios on the frontier offer the maximum return for a given level of risk. Points below the frontier are inefficient because a better trade-off is available. Question 17. Diversification within a portfolio is primarily intended to reduce which type of risk? Is it A. Systematic, market, risk, B. Purchasing power risk, C. Unsystematic, company-specific, risk, D. Interest rate risk on all bonds? The correct answer is C. Diversification spreads investments across many securities and sectors to reduce unsystematic risk, which is specific to individual companies or industries. Systematic or market risk affects the entire market and cannot be diversified away. This distinction is fundamental to portfolio construction. Question 18. An economist states that the money supply and general price level tend to move together over time. This view is most closely associated with which school of thought? Is it A. Behavioral economics, B. Keynesian economics, C. Supply-side economics, D. Monetarist economics? The correct answer is D. Monetarists, led by Milton Friedman, argue that changes in the money supply are the primary driver of inflation and nominal output. Keynesians emphasize aggregate demand and fiscal policy. Supply-siders focus on tax and regulatory incentives to production. Question 19. The Trainer ratio measures a portfolio's excess return per unit of, is it A. Liquidity risk, B. Total risk, using standard deviation, C. Unsystematic, company-specific, risk only, D. Systematic risk, using beta? The correct answer is D. The Trainer ratio divides a portfolio's excess return by its beta, measuring reward per unit of systematic, market, risk. The Sharpe ratio instead uses standard deviation, measuring reward per unit of total risk, which is the trap in the second option. The two ratios differ only in the risk measure used in the denominator. Question 20. A client in a high tax bracket seeking tax-advantaged income would most likely benefit from which of the following? Is it A. High-yield corporate bonds, B. Money market funds, C. Certificates of deposit, D. Municipal bonds? The correct answer is D. Municipal bond interest is generally exempt from federal income tax, making munis especially valuable to investors in high tax brackets on an after-tax basis. Corporate bonds, CDs, and money market funds generate fully taxable interest. Advisors compare yields on a taxable equivalent basis to confirm the benefit. Question 21. An advisor evaluating two portfolios with equal returns should generally prefer the one with which characteristic? Is it A. The higher beta, B. The lower correlation to treasury bills, C. The higher standard deviation, D. The lower standard deviation? The correct answer is D. When two portfolios offer the same expected return, the one with lower standard deviation carries less risk and is therefore more efficient. Rational, risk-averse investors prefer less volatility for the same reward. This risk-adjusted thinking underlies measures like the Sharpe ratio. Question 22. If interest rates rise, what generally happens to the price of an outstanding fixed-rate bond? Is it A, the price rises proportionally with rates? B, the price is unaffected because the coupon is fixed? C, the bond automatically converts to a floating rate? D, the price falls? The correct answer is D, bond prices move inversely to interest rates, so when rates rise, existing fixed-rate bond prices fall. This inverse relationship is a core principle of fixed income. Longer duration bonds fall more sharply than shorter duration bonds for the same rate increase. Question 23. A company's current ratio is calculated as which of the following? Is it A, total liabilities divided by total assets? B, net income divided by total shareholders' equity? C, earnings before interest and taxes divided by interest expense? D, current assets divided by current liabilities? The correct answer is D. The current ratio measures short-term liquidity by dividing current assets by current liabilities. Net income over equity is return on equity, and total liabilities over assets is a leverage ratio. EBIT over interest expense is the interest coverage ratio. Question 24. A stock's beta is 1.5. If the market rises 10%, what does beta suggest about the stock's expected move? Is it A, the stock is uncorrelated with the market? B, the stock would be expected to fall about 15%? C, the stock would be expected to rise about 15%? D, the stock would be expected to rise about 6.7%? The correct answer is C. Beta measures systematic risk relative to the market. A beta of 1.5 means the stock is expected to move 1.5 times as much as the market. A 10% market gain implies an expected 15% gain. Beta above 1.0 indicates greater volatility than the market. Question 25. A call option gives the holder which right? Is it A, the obligation to buy the underlying asset at the market price? B, the obligation to sell the underlying asset at the strike price? C, the right to sell the underlying asset at the strike price? D, the right to buy the underlying asset at the strike price? The correct answer is D. A call option grants its holder the right, not the obligation, to buy the underlying asset at a fixed strike price before expiration. A put option, by contrast, grants the right to sell. The option writer, not the holder, takes on an obligation. Question 26. An index mutual fund is designed primarily to, is it A, guarantee a positive return each year? B, outperform its benchmark through active security selection? C, invest only in tax-free municipal bonds? D, replicate the performance of a specified market index at low cost? The correct answer is D. An index fund passively tracks a benchmark, aiming to match rather than beat it, with low turnover and low expenses. Active management, the trap in the first option, tries to outperform through security selection and typically costs more. No fund can guarantee a positive yearly return. Question 27. Under the Uniform Securities Act, which of the following is excluded from the definition of a security? Is it A, fixed insurance policy or fixed annuity? B, a share of common stock? C, a corporate bond? D, an investment contract? The correct answer is A. Fixed insurance policies and fixed annuities are generally excluded from the definition of a security because they do not involve investment risk to the purchaser in the same way. Stocks, bonds, and investment contracts are securities subject to registration and anti-fraud provisions. Variable annuities, by contrast, are securities. Question 28. A required minimum distribution, RMD, generally applies to which type of account? Is it A traditional IRA once the owner reaches the applicable age? B. A Roth IRA during the original owner's lifetime? C. A taxable brokerage account? D. A 529 education savings plan? The correct answer is A. Traditional IRAs and similar pre-tax retirement accounts require minimum distributions beginning at the age set by law, ensuring the deferred amounts are eventually taxed. Roth IRAs are not subject to RMDs during the original owner's lifetime. Taxable brokerage and 529 accounts have no RMD requirement. Question 29. Using the constant growth dividend discount model, a stock expected to pay a $2 dividend next year, growing 4% annually, with a required return of 9%, has an estimated value closest to, is it A. $22.22? B. $40? C. $20? D. $50? The correct answer is B. The constant growth, Gordon, dividend discount model values a stock as next year's dividend divided by the required return minus the growth rate, $2 divided by 0.09 minus 0.04, equals $2 divided by 0.05, or $40. The $22.22 trap comes from forgetting to subtract growth, $2 divided by 0.09, and $50 from dividing by the growth rate alone. Question 30. Interest paid on most general obligation municipal bonds is generally treated how for federal tax purposes? Is it A. Exempt from federal income tax? B. Taxed at the long-term capital gains rate? C. Fully taxable as ordinary income at the federal level? D. Subject to a mandatory 20% federal withholding? The correct answer is that interest on most municipal bonds is exempt from federal income tax, which makes them attractive to investors in higher tax brackets. This tax advantage means municipal yields are often compared on a taxable equivalent basis. Capital gains on munis, however, can still be taxable. Question 31. The wash sale rule disallows a tax loss if the investor buys a substantially identical security within what period? Is it A. 30 days before or after the sale? B. 60 days before the sale only? C. 7 days before or after the sale? D. The same trading day only? The correct answer is A. The wash sale rule disallows a capital loss deduction if a substantially identical security is purchased within 30 days before or after the sale, a 61-day window in total. The disallowed loss is added to the cost basis of the replacement shares. This prevents investors from claiming a loss while maintaining the same position. Question 32. An investor holds a portfolio of 30 stocks across many industries. Which risk remains that cannot be diversified away? Is it A. Default risk of a single issuer? B. Systematic market risk? C. Business risk of one company? D. Industry-specific risk? The correct answer is B. Broad diversification across many companies and industries reduces unsystematic risks such as business, industry, and single-issuer default risk. However, systematic or market risk, arising from factors affecting the entire market like recessions or interest rate shifts, cannot be diversified away. This residual risk is measured by beta. Question 33. The Consumer Price Index, CPI, is primarily used to measure which of the following? Is it A. Changes in the price level of a basket of consumer goods and services? B. The unemployment level? C. The total output of the economy, measured as the real gross domestic product produced across all sectors? D. Corporate earnings growth? The correct answer is A. The CPI tracks the average change over time in prices paid by consumers for a representative basket of goods and services, serving as a common inflation gauge. Total output is measured by GDP. Unemployment and corporate earnings are separate economic statistics. Question 34. Which of the following is generally classified as a coincident economic indicator? Is it A, the average duration of unemployment? B, industrial production and personal income? C, new orders for consumer goods and materials? D, building permits for new private housing? The correct answer is B, coincident indicators move in step with the overall economy. Industrial production and personal income are classic examples. New orders and building permits are leading indicators that turn before the economy, and the average duration of unemployment is a lagging indicator. The trap is confusing leading indicators with coincident ones. Question 35. Which of the following best describes a zero-coupon bond? Is it A, it is issued at a discount and pays no periodic interest, maturing at par? B, it pays a higher coupon than comparable bonds and distributes that higher interest to holders every single month? C, it cannot be issued by the U.S. Treasury? D, it pays interest monthly rather than semi-annually? The correct answer is A. A zero-coupon bond is sold at a deep discount and makes no periodic interest payments, returning full par value at maturity. The investor's return is the difference between the purchase price and par. Treasury strips are a common example of zero-coupon instruments. Question 36. Under current federal rules, long-term capital gains, on assets held more than 1 year, are generally taxed. Is it A, at preferential rates lower than ordinary income rates? B, not at all? C, at the same rate as ordinary income? D, at a higher rate than ordinary income because of an additional federal surtax imposed on long-term gains? The correct answer is A. Long-term capital gains on assets held more than 1 year are taxed at preferential rates that are generally lower than ordinary income tax rates. Short-term gains, on assets held 1 year or less, are taxed as ordinary income. This favorable treatment rewards longer holding periods. Question 37. Generally, an investment advisor managing $110 million or more in assets registers with which regulator? Is it A, FINRA as a member firm? B, the Federal Reserve? C, only the state securities administrator where its office is located? D, the Securities and Exchange Commission, SEC? The correct answer is D. Advisors with assets under management of $110 million or more are generally required to register with the SEC as federal covered advisors, while smaller advisors typically register with the states. The $100 million to $110 million range creates a buffer to reduce frequent switching. FINRA regulates broker-dealers, not investment advisors. Question 38. An investor who owns 100 shares of a stock and sells, writes, one call option against those shares has established A. Is it A, long straddle? B, naked call carrying unlimited risk? C, protective put? D, covered call, earning premium income while capping gains above the strike? The correct answer is D, owning 100 shares and writing one call against them is a covered call. The premium adds income and a small downside cushion, but upside is capped at the strike price. Because the shares are owned, the written call is covered, not naked, which is the trap that would carry unlimited risk. A protective put involves buying, not selling, an option. Question 39. Under the Uniform Securities Act, the anti-fraud provisions apply to which persons? Is it A, only advisors registered with the SEC? B, anyone who offers or sells securities or provides investment advice, whether registered or not? C, only broker-dealers, never investment advisors? D, only issuers of new securities? The correct answer is B. The anti-fraud provisions of the Uniform Securities Act reach any person who offers, sells, or advises on securities, regardless of whether that person is registered. Registration status does not exempt anyone from liability for fraud. This broad reach is a cornerstone of investor protection under state law. Question 40. Under the time value of money, Which factor increases the future value of a single deposit? Is it A shorter investment horizon that leaves the deposit invested for fewer total compounding periods? B, a lower rate of compounding? C, more frequent withdrawals made throughout the period, which add to the deposit's accumulated future value? D, a higher interest rate compounded over more periods? The correct answer is D, future value grows with higher interest rates and more compounding periods, because each period's interest earns further interest. Shorter horizons and lower rates reduce future value. Withdrawals reduce the balance that can compound.